Hello everyone, how are you? I hope all of you are doing really good. So welcome to another session of the financial management theory and this chapter, that is sources of finance or the types of financing, one and the same thing, right? So we have covered a major part of it. In this particular lecture, we'll try to cover the remaining part and we'll be picking up only the important part. Again, I will be explaining you the concept, that what is the concept behind these sources, right? Whatever the other sources are, and then you will read it and understand it. Okay, the first source under the other sources is the seed capital assistance. What is seed capital assistance? It is the scheme designed by IDBI. It was given for the professionally and technically sound entrepreneurs, right, who lack funds, who do not have the funds, right, adequate financial resources. They lack adequate financial resources, so they decided to give these entrepreneurs the money, the finance, who have the right skills, they are qualified, they are professionally, technically qualified, and they want to start their startups, but they lack funds. So this is the scheme that is given by IDBI. It is interest free, right? It is normally interest free, but yes, the interest can be charged depending upon the situation, depending upon the financial condition of the startup. But they usually charge a service charge of 1% for the first 5 years and increasing rate thereafter, right? IDBI have the option to charge interest at the rates as may be determined. So this is called as seed capital assistance. After that, internal cash accruals. This is very simple. Internal cash accruals is if you have the accumulated reserves and whatever the profits that you are internally generating, those profits and those reserves you can use for the capital investment, for your for the growth and for the financing purposes, you can use that money. Next is the unsecured loan. Now this unsecured loan is given by the promoters. Now if you talk about the loans, right, here what he is talking about is that loans can be of two types. One is given by the promoters of the company, right, those who are starting, those who are promoting the idea, those who are promoting the company. Another is the institutional loans. Other is the institutional loans, right? Now these promoters will provide an unsecured loan. There is no security which is required. Institutions will provide a secured loan, sir. Obviously you will need to provide. Institution is if you get the loan from a bank or any other financial institution, right? So that will be backed up by a security, whereas the promoters, for the promoters, it will be an unsecured loan. Clear? Now in this case, the rate of interest will be low rate of interest, right? Then institutional loan. Secondly, when we talk about the repayment and the interest payment, the institutional loan, the loan from the institutions, from the bank and other financial institutions, it will be given the preference over the unsecured loans, right? The unsecured loans will be paid afterwards once these institutional loans are paid. Clear? So this is an unsecured loan. This is another source of finance. Deferred payment guarantee. Deferred payment guarantee is you want to buy a machinery, a capital asset or a machinery. Let's say the machinery is 1 CR and you want to completely finance this machinery, finance from bank. Now the supplier says, sir, pay this 1 crore after 60 days. He is giving us the credit period on this asset, but he requires a bank guarantee here. He requires a bank guarantee here that okay, this machinery is being financed from the bank. After 60 days, after the credit period, the bank will transfer the money to the supplier, right? So this is what is known as the deferred payment guarantee. The payment is deferred. The payment is to be paid after a certain period, but it should be backed by a guarantee by the bank, right? So this is known as deferred payment guarantee. Next is capital incentive. Now capital incentives are what? This is a sort of the lump sum subsidy being provided to the firm who are going to set up in the backward areas, who are going for the backward area development, those projects, right? That is if the government is providing the subsidy or the exemption or the deferment of the taxes or duty, that is known as capital incentives, right? So I'm just giving you the overview, I'm just giving you the idea that what it is, because ultimately you have to write in own language, and once you listen to it what it means, then you can easily read it. And retention from listening. Then deep discount bonds are the zero interest bonds, right? They are sold at a discounted value, and on maturity the face value is paid to the investor. So three things are important here. Zero interest, no interest is to be paid, sold at a discounted value, and on the maturity the face value is paid. Secured premium notes. Now what are these secured premium notes? They are issued along with the detachable warrant and is redeemable after a notified period of say 4 to 7 years. What it is, these secured premium notes are, they have two things. One, it is in the nature of bonds, right, carrying the interest rate, carrying a fixed interest rate. Okay, the second is these secured premium notes have a detachable warrant. What is a detachable warrant? That when they are going to, it is going to be redeemed after 4 to 7 years. Clear? Now he says at that particular time, this is detachable warrant gives you the option to convert secured premium notes into the equity shares, right? But this conversion should take place within a specified period of time only, right? So this is regarding the secured premium notes, right? Okay, next one is zero interest fully convertible debentures. So as the name suggests, there is an option to fully convert them into the equity shares after a specified period, and there is no interest. Fully convertible debentures which do not carry any interest. The debentures are compulsorily and automatically converted after a specified period of time, and the holders thereof are entitled to new equity shares of the company at the predetermined price, right? So it has to be converted. There is no option, it has to be converted. Zero coupon bonds, they do not carry any interest, sold by the issuing company at a discount. The difference between the discounted value and the maturing or the face value represents the interest to be earned by the investor. Now you will say, sir, what is the difference between zero coupon bonds and the deep discount bonds? Sir, in case of deep discount bonds, on the maturity, the face value is to be paid. In case of zero coupon bonds, at the time of maturity, we can pay a different value than the face value. It can be more than the face value, it can be less than the face value. Normally it is more than the face value, right? And whatever is the difference between the discounted value, let's say the debenture is for 100 rupees, right? And you have issued it for 90 rupees and redemption value is 110. So this 20 rupees is what? This 20 rupees is the interest that is earned by the investor. That is the benefit that he is getting. He paid 90 rupees for the debenture, and at the time of redemption he is getting 110 for the debenture, right? So this is the benefit that he is getting, sir. Option bonds. Option bond is where they have the option whether to go for cumulative or non-cumulative bonds, right? Whether the interest is payable on the maturity or periodically. That's it. Inflation bonds are the bonds which are adjusted for inflation, right? For example, if the interest rate is 11% and the inflation is 5%, the investor will earn 16%, meaning that he is covered by the inflation, right? So if inflation increases, accordingly the interest rate will also increase, so that the investor is protected against the higher inflation, right? Higher inflation, the prices will increase. Now the investor will think, sir, I am getting 11 rupees and the inflation is reaching 8 rupees. When I invested in the bonds, let's say there is an investor who invested in the bonds on 1st of April. At that time, the interest rate is 11 rupees and the inflation is 2 rupees, right? So he will be having 9 rupees in the pocket. Now over a period of time, what happened, sir? On 30th of June, when he checked, he is getting 11 rupees, but the inflation has reached 8 rupees. Now he will be having only 3 rupees in the pocket. So the company says, don't worry, we will cover you for the inflation, we will pay more. We will pay more, right? We will add inflation to it. Clear? So that is what is there. Floating rate bonds which do not have a fixed rate of interest, where the fixed rate of interest keeps on changing. As the name suggests, floating rate. Floating rate means there is no fixed rate of interest. The rate of interest keeps on changing according to the scenarios, right? According to the market scenario. market conditions, right? So that is all about the other sources of finance. Please just read it, just give it a plain reading, and what you should remember is the basic understanding of the concept, that what is the concept you should remember. Rest you can write it in your language, you no need to cram each and everything. Now coming to international financing, when we talk about international financing, that is we want to raise the funds from the international market. In this part, the only important part is, one is the external commercial borrowings. External commercial borrowing is when you borrow, when you get the loans, refer to the commercial loans in the form of bank loans, buyer's credit, supplier's credit, etc., availed from the non-resident lenders. That is, you are sitting in India, you are getting a loan from the Bank of America, right, with a minimum average maturity of 3 years. With a minimum maturity of 3 years, it can be for a higher period, right? So this is external commercial borrowings. These euro bonds and all, just give it a plain reading, that's it, not important at all. Green bonds and all, green bonds are what? These are the bonds issued which are for the projects which are for the the environment. Those are green bonds. Social bonds, any project which is being taken for the social upliftment, right? The bonds being issued, the money being raised by the issue of bonds for a project which is for the social upliftment, that is a social bond. Sustainability linked bonds, that is not for any specific purpose, but it can be for a purpose which is related to the environment or which is for the social desirability, and the money is being given for that. Important here is the ADRs and the GDRs, right? The most important here is the American depository receipts and the global depository receipts. What are these? Sir, ADRs are what? The ADRs, when we talk about ADRs, sir, there is a company, there is an Indian company, right, who want to list their shares on the American stock exchange in America, right? And the American people, they want to invest some money in the Indian companies. So that is where the ADRs come into play, right? ADR represents, these are the securities offered by the non-US companies, that is by an Indian company. They will issue the ADRs who want to list on any of the US exchange, right? Each ADR represents a certain number of companies' regular shares. So ADR represents the number of shares, and they are getting listed on the American stock exchange, right? It allows the US investors to buy the shares of these companies without the cost of investing directly in the foreign stock exchange. So the double benefit is there. Double benefit is there for the company. Let's say it is an Indian company. For the Indian company, they will be able to raise the money, right? They will be able to raise the foreign currency. Secondly, the foreign people, the US people, they will be able to invest in the Indian company. If they are seeing the potential, the growth, they can invest easily without going to the foreign exchange market. They can invest in their regular stock market, right? They will buy the shares, they will get a certain part of the shares of the Indian company, right? The Indian companies have preferred GDRs to ADRs. Why it is, I'll tell you that. First, let's try to understand what are the GDRs now. In case of ADR, the company can list only on the American stock exchange. In case of the GDR, it is similar to ADR, right? You are issuing the shares, right? And you want to list on, you can list on any of the stock exchanges globally, right? It can be the London stock exchange, it can be the Luxembourg stock exchange, any stock exchange, you can list your shares, you can list yourself, right? So that is why the GDRs are preferred. Why? Because he says why the Indian companies have preferred GDRs over ADRs. The reason being the American, they are highly volatile. The American markets are highly volatile. The risk is quite high in America, right? That is why the people have been, preferring the GDRs over the ADRs. These are the negotiable certificates held in the bank of one currency representing a specific number of shares of a stock traded on the exchange of another country. The Indian shares being traded on the London Stock Exchange, right? Financial instruments are used by the companies to raise capital in either dollars or euros. Okay, in case of ADRs, the transactions are taking place in the US dollar, right? But in case of the GDRs, it can be in the dollars, it can be in the euros, right? They are mainly traded in the European countries and particularly in London, London Stock Exchange is there, right? So ADRs, they are majorly being traded in the US dollar because that is on the American Stock Exchange. So it has to be traded in the American dollar, whereas the GDRs can be in the dollars, it can be in the euros, it can be in any other currency, right? Then they have the Indian depository receipts also. IDRs, what are the IDRs? If some foreign company wants to list their shares on the Indian Stock Exchange, there is an American company, they want to list the shares in the Indian Stock Exchange, then they will issue the IDRs. Clear? So this is the difference between ADR, GDR and IDR. This is the basic concept of the three. Now this is an important topic, right? American depository receipts, GDR, that is the global depository receipts, this is important, and the IDRs, this is also important, right? So these are the few important topics. Now the contemporary sources of financing, here the most important one is crowdfunding. What is a crowdfunding? Crowdfunding is basically when you are a startup, you are an entrepreneur, you are going for a startup, you need money, right? How will you raise money? You raise money from the multiple people, from a group of people, not from an individual investor or an individual company. You raise the money from multiple or a group of people, small money. You issue one share to let's say 1,000 people and you raise money against that. That is crowdfunding, right? When you are getting the finance from a huge crowd. The crowdfunding means raising the money for an individual or organization from a group of people to fund a project, typically via the internet, via social, via crowdfunding sites are there, sir. A lot of crowdfunding sites are there, especially in terms of the medical, right? In terms of medical, the crowdfunding sites are doing what? They are collecting the funds on behalf of the patients, that okay, this patient is serious, this kid is serious, right? I don't know, there are many sites, Health Guru and all those, I don't remember. These are the crowdfunding sites. They get small money. They will ask you to pay only 500 rupees, sir, please contribute 500 rupees, the life of a person will be saved, right? He needs surgery, he needs 50 lakhs for the surgery, but he is a poor person, so please pay at least 500 rupees or whatever you wish to contribute, right? Impact Guru I think is one site. Let me check. That is a crowdfunding site. Just check. What they are doing is they are collecting the money from the people for a particular person or for a particular organization. Yes, it is Impact Guru. That is a crowdfunding in India. It is clearly written Impact Guru crowdfunding in India, right? So that is what is there. Impact Guru, need funds for your medical treatment. Yes, right? So that is crowdfunding. Simple, in simple terms. Three parties are involved in this: the fundraiser, mediator, and the fund investor, right? There is a person, there is a patient who needs money. That is a fundraiser. Mediator is the Impact Guru who is going to raise the funds, and fund investor is if I invest in that. I am the fund investor, right? And the platforms may also charge a certain fee in the form of processing fee, transaction fee, either as a fixed amount or percentage or in combination of both. Yes, normally this is through the social media and internets, and the platforms, the Impact Guru will charge certain kind of a fees. That is for sure, right? The source of funding helps the startup to substantiate the demand for their product before entering into the production. Equity funding is the equity crowdfunding, where the investor invests money in the organization and receive the securities of that organization in return, right? Either you pay in the cash or you get a certain part, right? If I pay to the Impact Guru and I ask them, I want the shares in your company, I want a certain part of the company, that is equity funding. Peer-to-peer lending is that there is a platform. Let's say on the internet, there is a particular platform. Here the buyer is there, here the seller is there, or the investor is there, we can say, not seller. I'll say there is an investor who is ready to invest money. He is having lots and lots of extra funds, and there is a borrower who needs money, right? He is ready to invest, he requires money, they will match each other, right? This is normally done being online, and the risk obviously is there. The risk obviously is there, sir. Right? Crowdfunding, where the lenders match with the borrowers in order to provide the unsecured loans through the online platform. The risk is there, paid back by the borrowers with the interest, though this kind of lending involves certain risk of default. Obviously, the risk of default is there. Startup funding is there for the funding for the startups through crowdfunding. Donation based crowdfunding is the Impact Guru. That is a donation based crowdfunding, right? So the example, the perfect example of this is the Impact Guru. You can check this site, right? That is a donation based funding. Startup funding is when you are doing the crowdfunding for a particular business, for the business purpose and not for the donation purposes, right? That is a startup funding. So with this, we are done with this chapter and we are done with the major part of the theory of financial management. This chapter was there, chapter number 2, sources of finance. We are done with it. Please revise it thoroughly. I have tried to make the things quite simplified and explain the things in quite a simplified manner. I hope all of you have enjoyed it. If you have enjoyed it, please like the video and share with all your friends, and do not forget to subscribe to the channel because this video is coming up on the YouTube also. See you guys in the next video. Till then, stay safe, stay healthy, keep studying, keep sharing. Thank you so much.